If you're a Canadian investor who wants to build wealth without spending every single weekend staring at spreadsheets and stock picking, you've probably heard the classic advice. Just buy VGRO and go to the beach. It is the ultimate lazy portfolio. One single ticker that holds thousands upon thousands of stocks and bonds and rebalances itself automatically, so you never have to lift a finger. But Vanguard isn't the only player in the game anymore. BlackRock has XGRO and BMO has ZGRO. All three of these funds offer the exact same profile, a mix of 80% stocks and 20% bonds. They look identical on paper, but when you look under the hood, there are subtle differences in fees, geographic weighting, and home bias that could change which one is right for your TFSA or RRSP. In this deep dive, we're finally going to settle the VGRO versus XGRO versus ZGRO debate. We're going to look at the VGRO's holdings, the XGRO dividend history, and why BMO ZGRO might actually be the secret weapon for investors looking for the lowest possible fees without sacrificing quality. So let's begin. Before we compare them, we need to answer the big question. What is VGRO, XGRO, ZGRO? These are known as asset allocation ETFs. In the old days, you had to buy 5 or 6 different funds to get exposure to the US stocks, Canadian stocks, emerging markets, as well as bonds. Then you had to manually calculate the math to keep them balanced. Now the fund manager does all of that heavy lifting for you inside a single ticker. When you buy a share of one of the ETFs, you're essentially hiring Vanguard to manage a globally diversified portfolio on your behalf. They handle the buying, the selling, the rebalancing every single time the market moves, whether it's up and down. And as of this year, there is a massive growth tilt that we're seeing. While they do have some bonds to cushion the blow during a market crash, the 80% stock allocation means this fund is built for long-term investors who have at least a 10-year horizon due to such a high stock allocation. Anyways, let's compare them now. Let's start from geographic weighting and fees, because I would say this is where the hidden differences live. While all three funds have a Canadian home bias, they don't apply the same way. VGRO is actually the leader when it comes to Canadian stock exposure, usually holding around 25% of its equity in Canada. This provides a massive home bias, which can be great for tax efficiency and reducing currency risks. But it also means you're heavily tied to the Canadian banking and energy sectors. In contrast, XGRO and ZGRO lean a bit more into the United States. XGRO typically has the highest US allocation of the three, hovering around 36 to 37%. And of course, it always moves around and gets adjusted. This means if you believe American big tech and the S&P 500 will continue to outperform the rest of the world, XGRO might be your preferred choice. On the fee side, both XGRO and ZGRO win with an MER of around about 0.2%, while VGRO sits slightly higher at 0.24%. Although I believe they're reducing the fees now, so it should be even lower going forward. Now let's look at the dividends. A very common question for new investors is, do the ETF, VGRO, XGRO, ZGRO pay dividends? And the answer is yes. But they're technically called distributions. Because all funds hold both stocks and bonds, your payout is actually a mix of stock dividends and bond interest. This makes a yield a little bit more stable than a pure stock fund, but it's still focused on growth rather than high monthly income. So that's something to think about. And all three of these funds pay out their distributions quarterly or every 3 months. You can generally expect a yield somewhere between 1.8% to 2.4% historically, depending on the year. The VGRO, XGRO, ZGRO dividend schedule typically sees payments in January, April, July, and October, so 4 times a year. If you're using a broker like Questrade or Wealthsimple, you can also set them to DRIP, which is an acronym for Dividend Reinvesting Plan. So they automatically buy more shares for you. Funnily enough, in almost every single VGRO versus XGRO Reddit thread, you will see people arguing about VEQT. The difference is simple but massive for your risk tolerance. So VGRO is 80% stocks and 20% bonds. VEQT, on the other hand, if you're comparing them, is 100% stocks. So if you're in your 20s or 30s and have the stomach to watch your portfolio drop 30% during a recession without panicking and losing your mind, many people choose to skip the bonds entirely. However, I wouldn't sleep on that 20% bond sleeve in VGRO. In 2022 and early 2024, for example, we really did see how the bonds can act as emotional insurance. They reduce the overall volatility of your account, making it much easier to stay invested over the years and decades when the headlines get very scary and the world seems to be falling apart. And if you're unsure which one to pick, VGRO is usually the safe starting point for most people because it balances growth with a bit of safety net, compared to VEQT, not compared to XGRO and ZGRO. So which one should you pick? To summarize, at the end of the day, the VGRO versus XGRO versus ZGRO debate is a win-win-win. If you're choosing between the 3 best engineered financial products in Canadian history, it's a little bit silly. They're incredibly liquid, they're cheap, and they all offer instant global diversification as well as diversification between equities and bonds. Your choice really comes down to which provider you trust more and which geographic tilt you prefer, although those are also incredibly slight. So I would say pick VGRO if you want the highest Canadian exposure and you value the Vanguard philosophy. Even with a slightly higher fee, VGRO has the highest trading volume and the most proven track record. Second, I would say if you want more exposure to the US market, I would pick XGRO, as well as if you're looking for the lowest possible fee. And it's the perfect middle ground for someone who wants growth, but trusts the S&P 500 will deliver higher returns than the TSX. And of course, I would pick ZGRO if you're a BMO investor and you want a slightly different mix of underlying bonds. It's very new, by the way, and a fantastic low-cost alternative that performs almost identical to XGRO. But instead of paying to BlackRock, you're paying to BMO. So that could be something you want to do. Anyways, guys, thank you for watching. Whether you're Team Vanguard, Team iShares, or Team BMO, the most important step is simply hitting that buy button and staying consistent. These all-in-one funds have made it easier than ever for Canadians to build real wealth. If this breakdown of VGRO versus XGRO and ZGRO helped you make a decision, please hit the like button. It really helps the channel and it puts a big smile on my face. I really appreciate it. It tells YouTube that my videos are somewhat watchable, and that's honestly all that matters. Anyways, guys, I appreciate you so much. Thank you so much for watching, and I'll see you in the next one. Take care.